Hello, dear students. Welcome to Ind AS 8 Accounting Policies, Change in Accounting Estimates and Errors. Accounting Policies, Change in Accounting Estimates and Errors. Um, if you are doing the standard for the first time, is this title reminds you of any other accounting standard you learned in your intermediate level? Yes, AS5. AS5, net profit or loss for the period, prior period errors and change in accounting policies. There are, of course, in this it is giving more insights into the accounting treatment if there is change in accounting policy, estimates and errors. So let's quickly get into this wonderful standard in days 8. So as the title says, we are focusing on three areas: accounting policies, change in accounting estimates, errors. So the standard talks about if there is an account, the standard talks about one, accounting policy. What is the meaning of an accounting policy? How do you select an accounting policy for a transaction? Can you change the accounting policy? And what is the accounting? Okay. Meaning, selection. Can you change an accounting policy? And what is the accounting? Very easy. You can adjust speed and watch because it is very much familiar to you. Now, accounting estimates, meaning, and what is the accounting when there is change in accounting policy? What is the accounting and disclosures? Prior period errors, of course, the errors are prior period. If there is current year error, just correct it. But if there is previous year errors committed in the financial statements, how it is to be dealt with. So, meaning and types and accounting of such errors. Accounting of restating. What is the accounting treatment to be done when you have to restate those errors? Okay, so let's start with accounting policies. What are accounting policies? What have we studied in our intermediate level? Accounting policies are specific accounting principles applied in the preparation and presentation of financial statements. Specific accounting principles, and there you have studied methods used for applying those principles in the preparation and presentation of financial statements. So same thing, but instead of methods, they have changed the lines to accounting policies are specific principles, bases, conventions, rules, and practices applied in the preparation and presentation of financial statements. Okay. So examples of accounting policies are inventory valuation methods, FIFO, weighted average cost method. FIFO and weighted average cost method. Then PP, subsequent measurement methods, that is cost model. As per Ind AS 16, you can go for cost model or you may go for revaluation model. These are accounting policies. Entities are free to choose their accounting policies provided that has to be disclosed. Yes or no? Yes. So that takes care of meaning. Meaning of accounting policies. Accounting policies are specific accounting principles, bases, conventions, rules, and practices applied in the preparation and presentation of financial statements. Okay. Now, how do you select an accounting policy for a transaction? Now, how do we select? Now, how do we select an accounting policy for a transaction? How do we select an accounting policy for a transaction? Okay, so selection and application of accounting policies. So, if specific Ind AS is available for a transaction, if Ind AS is available, just apply that policy. But Ind AS is not available, then use entity's judgment in formulating and applying an accounting policy. Not clear. Okay. So what is given here? If specific Ind AS is available for a particular transaction, the entity shall apply the accounting policy specified in that particular Ind AS. Okay. However, if such a policy does not exist, then entity shall refer the following sources in descending order. So what does that mean? So transactions like Bitcoin, cryptocurrencies, carbon credits, there are no Ind AS. So then you check other Ind AS on similar transaction. How do the entities account as per other Ind AS? What is given in other Ind AS relating to a similar transaction? Then check framework of Ind AS. Framework of Ind AS. Now, pronouncements of International Accounting Standards Board. Is there any pronouncement like guidelines? There is no Ind AS, but there is a notification or guidelines released by our International Accounting Standards Board. Now, if IASB has not released a pronouncement on it, then check pronouncements of other standard setting boards like US GAAP. Because US GAAP we have, IGAP we have, IFRS we have. IFRS and IGAP is already checked. Now you find out what is given in US GAAP for the similar transaction. If that is also not there, then accepted industry practices. In industry, what others are doing, that we'll follow. So how an entity select an accounting policy for a transaction? Okay, for a transaction, if there is an Ind AS exist, we'll definitely go for the guidance given in Ind AS. If Ind AS does not exist, then I have to apply the judgment. The entity should apply the judgment and formulate an accounting policy. So how do I formulate? First, check other Ind AS on similar transactions. If it is not there, then framework on Ind AS. If that is also not mentioned in the framework, then pronouncements, any guidance notes or notifications released by IASB. If it is not there, then go for other standard setting boards like US GAAP, pronouncements by US GAAP. If that is also not there, then accepted industry practices. Okay, that is how we select an accounting policy for a transaction. Okay. Now, consistency. The entity should follow the accounting policies consistently unless an Ind AS requires a specific policy to be adopted. Otherwise, all accounting policies are to be consistently followed. Basic. Okay. Now, can you change an accounting policy? Can you change an accounting policy? Yes. You can change an accounting policy only if the change is required by an Ind AS. A mandatory change is required by an Ind AS, you can change the accounting policy, or the change results in more reliable and relevant information about the transactions in entities' financial statements. So, one is a mandatory change. You do not have an option. If another Ind AS is saying otherwise, you have to go for it. Mandatory change. The other one is voluntary change to provide more reliable and relevant information about the transactions to the users. If it is so, can you change an accounting policy? Yes, if it is required by Ind AS or it results in financial statements providing more reliable and relevant information. Entity can change accounting policies if it is required by another Ind AS. Okay, fine. And results in more reliable and relevant information. Fine. Now, the following are not change in accounting policies. The following are not change in accounting policies. So, accounting policy differs in substance from previously undertaken. So, for the same transaction, if you had a different policy before and now you are following a different policy, then it is change in accounting policy. Then it is change in accounting policy. But you or the accounting policy differs in substance from the previously undertaken. So accounting policy differs in substance from previously undertaken. I didn't understand. Now the transactions did not occur previously or were immaterial. Okay, now what is this? I'll take an example from your study material to understand that this is not change in accounting policy. So what is this? A carpet retail outlet sells and fits carpets to the general public. A carpet retail outlet sells and fits carpets to the general public. It recognizes revenue when the carpet is fitted. which on an average is 6 weeks after the purchase of carpet. So which means we sell carpets to the general public. We recognize revenue only when the carpet is fitted to the customer's premises, which is on an average take 6 weeks. It then decides to subcontract the fitting of carpets to self-employed fitters. It now recognizes revenue at the point of sale of the carpet. So earlier, you were fitting the carpet. Now you have outsourced to self-employed fitters, and now you recognize revenue at the point of sale. Whether the change in recognizing the revenue is a change in accounting policy as per the provisions of Ind AS 8. What do you think? No. Why it is not? Let's read the answer. What is given? This is not change in accounting policy, as the carpet retailer has changed the way that the carpets are fitted. There would not be any need to retrospectively change the prior period figures. So earlier you were doing it, now you have outsourced to fitters. The transactions are in substance different. So it is not a change in accounting policy. Are you understanding? So the following are not change in accounting policy. The accounting policy differs in substance from the previously undertaken, and transactions did not occur or totally a new transaction happening, or the transaction happened before were immaterial. Then you cannot say there is change in accounting policy. Any revaluation in assets as per 16 or 38 is a change in accounting policy to dealt with their respective standards. So this sentence is actually not with relate to this. Now, what is given in the standard? As per Ind AS 16 and Ind AS 38. As per Ind AS 16 and Ind AS 38, we have already said subsequent revaluations as per Ind AS 16, Ind AS 38 is change in accounting policies, but it is to be accounted as per respective standard. If PP is revalued or intangible asset is revalued, the accounting is to be done as per Ind AS 16 and Ind AS 38 respectively. It has nothing to do with Ind AS 8. Okay. Now, what is the accounting? Now, what is the accounting? What is the accounting when there is a change in accounting policy? What is the accounting? If there is a transitional provision, earlier you are following one accounting policy, now you change to another accounting policy. If there is a transitional provisions given, like earlier it was Ind AS 17. The accounting policy in the books of lesser was different when new standard introduced Ind AS 116. So transitional provisions are there. So if transition provisions are mentioned in Ind AS, then apply those provisions. Okay, you remember full retrospective approach, modified retrospective approach number 1, modified retrospective approach number 2. Then apply the changes retrospectively unless impracticable. Retrospective means adjust the opening balance of each affected component of equity of the earlier prior period presented and the comparative amount disclosed for each prior period presented as if the new accounting policy has always been applied. Not clear, not clear. Let's find out. Let's find out with the help of an example. Let's take question number 1 is very easy, study material question only. Okay, I'll read this. Entity ABC acquired a building for its administrative purpose and presented it as PP. Okay, we remember the definition of PP. Property, plant and equipments are tangible assets held for use in the ordinary course of business. For production of goods, rendering of services, rental to others, and administrative purpose. So you're using it for administrative purpose. So it's a PPE. During the financial year 12-13, it relocated the office to a new building and leased the said building to a third party. Oh, so it is let out building now, leased out building now. So if it is leased out building, you will
reclassify it as investment property. Following the change in the usage of the building, entity ABC reclassified it from PPE to investment property. So do you remember in Ind AS 40 we saying, as per Ind AS 40, transfers are permitted between PPE and investment property and inventory. The reclassification can be made only when the change in use is evidenced, and reclassification do not change the carrying value. Yes, you remember that. Okay. So is it a change in accounting policy? Of course not. It is not change in accounting policy. It is change in use of the building. So it's not, it has nothing to do with accounting policy disclosure, change in accounting policy or similar disclosures. Okay, question number 1. Study material question. Yeah. So what is the accounting if there is change in accounting policy? So best example is this question number 2. So let's understand. ABC Limited changed its method adopted for inventory valuation in the year 1213. Prior to the change, inventory was valued using FIFO method. So 2012-13. Now we are changing the inventory valuation. Before that, we were following what method? We were following FIFO method. Now, however, it was felt that in order to match the current practice and to make financial statements more relevant and reliable, so voluntarily the company decided to change to maybe weighted average cost method. Okay, fine. So on 31st March 2011, based on the new method, 10 million increase, 12, 15 million, 13, 20 million, profit or loss under FIFO valuation is given, opening retained earnings is given. You are required to present the impact of change in accounting policies in P&L and produce the extract of statement of equity with Ind AS 8. Okay, fine. Now, what is the rule when there is change in accounting policy? When there is change in accounting policy, first, if change in accounting policy, I'm writing this because I want you to be very clear with this. When there is a change in accounting policy, first apply transitional provisions if there transitional provisions. So there is no transitional provisions here. Then apply, then retrospectively apply the change in accounting policy. If impracticable to do so, if impracticable to do so, apply as far as practical. If impracticable to do so, retrospectively apply as far as practical. If nothing is practical, then account prospectively. Very, very important. I want you to learn these lines. So if there is a change in accounting policy, what is the treatment when there is a change in accounting policy? What is the treatment when there is a change in accounting policy? Please study here. Apply transitional provisions. There is no transitional provisions. Then you should apply it retrospectively. If retrospective application is impracticable, then retrospectively apply as far as practical. If nothing is practical, then account prospectively. So let me give you an example. So current year is 2000, sorry. So current, say for example, current year is 2025-26. Your company was following FIFO method from 2009-2010. Your company was following FIFO method from 2009-2010. Now, what the standard requires, is there any transitional provisions available? No. There are no transitional provisions available. Then you go to 2009-10 as if from 2009-10 you are following weighted average cost. You are following FIFO. Now in this year you change to weighted average cost. Now my standard says you go to this year and apply weighted average cost as if weighted average cost method you are following from 2009-10 onwards. Okay, so that is what my point number 1, retrospective application. But if it is impracticable to do so, you're like 2009-10 onwards, 2009-10 onwards correction is not possible. 2009-10 onwards retrospective application is not possible as you don't have records. Okay, so you maintain as per Companies Act maybe maximum 8 years books of accounts. You don't have accounts from 2009-10 onwards. Then what we'll do is, okay, then you go back to the last 8 years, say for example 2018-19 onwards, you make the correction. And you are like 2018-19, so that is what, if impracticable to do so, retrospectively as apply as far as practical. But in 2018-19, you are like, there was flood and flood destroyed our contents, our software, our all books of accounts were destroyed. Okay, then you apply from 2019-20 onwards and you're like, income tax department has seized all those books of accounts and it is not available. So we are asking then books of accounts from 2021 is available. So which means you apply retrospectively from 2021 and onwards. You apply from 2021 and onwards if this is available. So listen what is given. Apply transitional provisions. If that is not available, retrospectively apply the change in accounting policy. If impracticable to do so, retrospectively apply as far as practical. If nothing is practical and you're like, nothing is practical, all the financial statements till the last year is seized by income tax department, then you apply from 25-26 onwards. Are you understanding? I hope so. So let's read this question number 2. So let's try this question number 2. Here we need to apply it retrospectively. So what is given? And if I go for retrospective, Okay, I hope this is clear. Now, if retrospective application is possible, current year, 25-26 financial year, if retrospective application is possible, should I go back to 2009-10 or 2018-19
and do the retrospective application in this books of accounts? Not required. Then go back to previous year 24-25. Then go back to the beginning of previous year, that is 1st April 24. You make the changes from 1st April 24. You remember Ind AS 1 opening balance sheet? We need to make the corresponding changes in inventory. We'll make the corresponding changes in inventory and retained earnings, opening equity. Corresponding inventory will change. So we'll make the changes in inventory and the corresponding gain or loss will be reported in retained earnings. Corresponding gain or loss will be reported in retained earnings. Okay, so that is what we have read here. So let me read the provision once more. Where is it? Yeah. Um, so if there is a new standard or interpretation, apply transitional provisions. If no transitional provisions, apply retrospectively. If it is impractical to apply retrospective application to prior periods, then apply new policy retrospectively to the earliest period practicable, which may be current period, and make a corresponding adjustment to the opening balance of affected component of equity for that period. Okay. Now let's try that question number 2. Let's answer that question number 2. So what is given in question number 2? So we change from FIFO to weighted average. Current year is 12-13. Sorry, current year is 12-13. So you need to make the changes in 11-12, and also you need to make the changes on 1st April 2011. Okay, so 31st March 2011, closing stock increased. Second year also closing stock increased. Third year closing stock increased. Profits are given. Okay. 31st March 11, opening retained earnings are also given. So what are the changes to be made? Okay, what are the changes? So on 31st March 2011, your closing inventory has increased by 10 million. So obviously your retained earnings will increase by 10 million. So your inventory will increase, correspondingly retained earnings also will be increased. Okay. Now 11-12. 11-12, what is going to be the change? Let me write this and then we'll check the answer. So it is 296 revenue. Cost of goods sold. Cost of goods sold 11-12, opening stock will increase by 10 million. So opening stock plus purchases minus closing stock. So opening stock will increase by 10 million and closing stock will increase by 15 million. So net effect is 5 million will be reduced from the cost. Closing stock increased. It's like a profit. So your cost of goods sold should be reduced. Yes or no? It's plus 10 minus 15. Plus 10 minus 15. So net minus 5. So this should be 159. 296 is your revenue. Your cost of goods sold has reduced. So as a result, or simple understanding, if closing stock has increased, opening stock has increased, there is a net effect of 5, profits should increase. So 296 minus 159, profit has increased to 137. Okay, expense reduced 74. So your net profit has become 63, 58 plus 5. Okay. Then 12-13, 324. Cost of goods sold. Opening stock increased by 15 and closing stock increased by 20. Again a minus
5. 173 minus 5, it is 168. So this is 156 minus 83, it has become 73. So what is the answer? The same thing, 63, 73. Statement of change in equity. Retained earnings. Previous, original, before retrospective application, it is 423. 58 given. So 423 plus 58 given is the closing on 11/12, plus 68 is the closing on 12/13, but 423 plus we adjusted 10, so it has become 433. Instead of 58, it has become 63. Instead of 68, it has become 73. So 549 has become 569. So there is an increase net effect of 20. That is actually the increase in closing stock. So I should start showing my inventory or the calculations from 1st April 11. What is the impact? What is my retained earnings? 433. 31st March 12, my retained earnings is 549. Not 549, 496. Sorry. 496. And 31st March 13, it has become 569. And also inventory. Inventory figures as such, only the increase they have mentioned, the figure as such is not given. Are you okay? What is the treatment of change in accounting policy? Come on guys, let's revise once more. What is given? Listen, all of you. What is an accounting policy? Accounting policies are specific accounting principles, bases, conventions, rules and practices applied in the preparation and presentation of financial statements. Okay. How do you select an accounting policy? If there is a Ind AS applicable, then we apply that Ind AS. If Ind AS is not applicable, then we need to apply our judgments, and an appropriate judgment is to be taken. For that, there is an order given. What is that order? What is that order? We'll first look at other Ind AS for similar transactions. Then we'll go for framework given in Ind AS, or else pronouncements of IASB, International Accounting Standards Board. If that is also not given, pronouncements by other standard setters like US GAAP, then accepted industrial practices. Can you change an accounting policy? Yes, if it is required by another Ind AS. That is a mandatory change, or else if the entity feels if the accounting policy is to be changed to provide more reliable and relevant information. Accounting, transitional provisions given, you should apply transitional provisions, or else uh, you should go for retrospective application from the beginning. But if retrospective application is not practical, apply as far as practical from the earliest comparative period. But that, if nothing is practical, then you need to account it prospectively. Okay. So that takes care of accounting policies. Now, accounting estimates. What are accounting estimates? Can you change an accounting estimate? And what is the accounting if there is change in accounting estimate? Accounting estimates. A change in accounting estimate is an adjustment of the carrying amount of an asset or a liability or amount of periodic consumption of an asset resulting from. So there is a change in the carrying amount of an asset or a liability or the amount of periodic consumption, useful life of an asset. The result is out of one, assessment of the present status and expected future benefits, obligations associated with assets and liabilities. The change in accounting estimates can also result from change in circumstances, new information, new developments, and are not correction of errors. Change in accounting estimates are not correction of errors. So, what is this? A change in accounting estimate can be a change in estimate can be as a result from assessment of the present status. Say for example, you a competitor has sued against you, so you created a provision. But based on the present status of the case, you will change the amount of provision. Yes or no? So, as an assessment of present status, or the depreciation method will change based on the expected future benefits. Useful life will change based on the expected future benefits and obligations associated with the assets and liabilities. Okay. So change in accounting estimates can be result from. I want you to learn this line. Change in accounting estimate can be as a result of change in circumstances, new information, new developments, and change in accounting estimates are not errors. Are not errors. Change in accounting estimates are out of the development of new circumstances, new information, and not errors. Okay. Now, how this change in estimate is to be accounted? It is to be accounted prospectively. So, change in accounting estimates can be a period of change, that is, that effect is only in one period, or it can have effects in the future periods. So, if there is a change in accounting estimate, nature and amount of change in estimate, um, and the amount of effect in the future periods. The nature and amount of change in accounting estimate that is having an effect in the current period or expected to have effect in the future periods. And amount of effect in future periods is not disclosed because it is impracticable. If the change is having an effect in the current year, you will disclose the amount of change, nature of change will disclose. If the amount of future periods are generally not disclosed, because what is the effect in future years may not be disclosed because it is impracticable. Okay, so that is very basic again. So let's do this errors and then move on to questions. So what are errors? Prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from failure to use or misuse reliable information. Prior period errors are omissions from financial statements or misstatements in financial statements arising out of failure to use. Why error happens? Because you were not careful. Failure to use, or you fraud, misused the reliable information. Okay. That was available. Actually, information was available when financial statements were approved for issue. If financial statements for those period approved for issue, that information was available. If you used it, then there would have been a mistake. Okay. Or could reasonably expected to have obtained and taken into account in the preparation and presentation of financial statements. Such errors include the effects of mathematical mistakes. You could have obtained all the information. The errors include mathematical mistakes, mistakes in applying accounting policies, oversight or misinterpretation of facts, and fraud. Okay, once more, this errors includes misinterpretation of facts, okay, mathematical mistakes, calculation errors, omission to record a material transaction. What is material? A transaction is said to be material if its omission influences the decisions of users, or mistakes in applying accounting policies and frauds are errors. Okay, fine. Are errors. So if there are errors in the prior period or prior periods, what is to be done? It is to be retrospectively restated. You do retrospective restatement. Okay, okay. If it is accounting policy, retrospective application. Here it is retrospective restatement. So correct material prior period errors retrospectively by restating the comparatives. If the error occurred before the earliest prior period, restate the opening balance of assets, liability, equity. If it is impracticable to do so, specific effects of the error, or impracticable to determine the period, specific effects of the error, restate opening balances. So if impracticable to do so, apply as far as practical, and you need to open whenever you have retrospective application, then sixth component, that is opening balance sheet, is required to be prepared. Okay, when there is a prior period error, nature of prior period error, effect of each line in the basic and diluted EPS, amount of correction at the beginning of earliest prior period presented, if it is impracticable, fact, and if possible, reasons should be specified. Okay, fine. So now let's try all the questions in the material in my workbook first, then we can go to, so question number 1, 2, I think we'll read 3. So 3, 4, 5, 3, 4, 5, 6, 3, 4, 5, 6. Question number 3. During 2012, Delta Limited changed its accounting policy for depreciating PPE so as to apply component approach completely while at the same time adopting the revaluation model. Okay, depreciating PPE to apply component approach completely while at the same time adopting the revaluation model. In years 2012, Delta Limited's asset records were not sufficiently detailed to apply a component approach fully. At the end of 2011, management commissioned an engineering survey which provided information on the components held and their fair values, useful life, residual value. You know, as per Ind AS 16, you need to follow component approach. And if you're following component approach, significant component of a PPE having significantly different useful life from the main asset has to be depreciated separately. So you have made the arrangements to do the component accounting in 2012. However, the survey did not provide a sufficient basis for reliably estimating the cost of those components that had not previously been accounted separately. And the existing records before the survey did not permit the information to be reconstructed. Delta Limited's management considered how to account for each of the two aspects of accounting change. They determined that it was not practicable to account for the change to a fuller component approach retrospectively. It is not possible to do retrospective approach, fuller retrospective approach, to change to fuller component approach, or to account change prospectively from the earlier date. Also, the change from cost model to revaluation model is required to be accounted prospectively. Delta's tax rate is 30%, PPE 25, depreciation 14, net book value 11, prospective depreciation for 2012 old basis is 1500. Now, as based on the engineering survey, valuation is now 17,000. Residual value has become 3,000. Remaining life is 7 years. Depreciation is 2,000. You are required to prepare relevant note for disclosure. Oh, so here, did you understand the question? They are going for component approach and also they are going for revaluation model. They are going for component approach and revaluation model. So if you are shifting from cost model to revaluation model, do I go for retrospective accounting? No. As per Ind AS 16, Ind AS 38, cost model to revaluation model, accounting is to be done as per the respective standards. Ind AS 16 and 38, we will not go for retrospective approach. We will not go for retrospective approach. Now, in these cases, what are the areas to be disclosed? What are the points to be disclosed? So here net book values 11,000 to 17,000. So there is a revaluation reserve in OCI 6,000. Remaining life is given. You are required to prepare relevant note and show the impact of each item in the financial statements. Tax rate is given, means if there is revaluation reserve profit, you should create deferred tax liability. Depreciation 1,500 has become future 2,000. So what are the impacts? So what are the impacts? Impacts the effect in current year to increase the carrying value by 6,000, increase in deferred tax by 6,000 into 30%, create revaluation surplus, create a revaluation surplus in OCI at the start of the year, 4,200. There is a revaluation profit and DTL. So you will show net 4,200 and depreciation increased. As a result, your current year tax will reduce by 150. That's it. Very easy. Question number 4. In 2013-14, after the entity's 31st March 13 annual financial statements were approved for issue, a latent defect in the composition of a new product manufactured by the entity was discovered. Latent defect means that the meaning of latent defect is what given in the brackets. That's a defect that could not be discovered by reasonable or customary inspection. By just doing a normal inspection, that latent defect, it's not a normal defect, a latent defect cannot be discovered by just going through that, by just going for a normal inspection. It's a hidden defect. As a result of this latent defect, the entity incurred 1 lakh in unanticipated cost. 1 lakh unanticipated cost for fulfilling its warranty obligation. Oh, sad. In respect of sales made before 2013, an additional 20,000 was incurred to rectify the latent defect in products sold during 13-14. Okay, so that is current year. So last year, 1 lakh provision for warranty. Then an additional 20,000 was incurred to rectify the latent defect in products sold during 13-14 before the defect was detected. Oh, and the production process rectified. 5,000 of which relates to items of inventory. Production process is now rectified. 31st March 2013. That last year we rectified rectified the closing stock and 5,000 we incurred. The defective inventory was reported at a cost of 15,000. Last year, cost 15,000. And NRV is 18,000. The accounting estimates made in preparing 31st March 13 financial statements were approximately made using all reliable information that the entity could reasonably expect to have been obtained and taken into account in the preparation and presentation of financial statements. Analyze the above situation in accordance with relevant Ind AS. So there was a latent defect which got identified or which got detected only now. So is it an error or change in accounting? Is it an error? It is not an error. It is not an error. It is change in accounting estimate. So Ind AS 8 is applied in selecting and applying accounting policies. 1. Accounting for change in accounting policies, change in accounting estimates, and correction of prior period errors. Now write the meaning of change in accounting estimate. It's an adjustment of carrying value of asset or liability or the amount of periodic consumption of an asset. This change in accounting estimate is as a result of assessment of the present status and expected future benefits, obligation associated with assets and liabilities. This is out of new information or developments and accordingly not correction of errors. Okay, and accounting policy should be recognized. Sorry, accounting estimates are to be adjusted prospectively. Okay. Now what is given? What are errors are also written. On the basis of new defect was neither non nor reasonably possible to detect. When it is considered as an error, when when it is considered as an error, error means failure to use or misuse reliable information, but reliable information was not there. Error means failure to use or misuse reliable information, but reliable information was not there. It was not available at the time of approval of financial statements. Yes, so the defect was not known or not reasonably expected to detect. So now you will create a provision. So it's an understatement of warranty provision, 1 lakh. So provision you increase by 1 lakh, and overstatement of inventory that I didn't understand. So cost of inventory 15,000 and NRV was 18. Now you spend 5,000 to make it saleable, to convert that inventory to saleable condition, you spend 5,000. So actually NRV is only 13. So 15, 13, whichever is lower, you should show inventory at 13. So effects of this latent defect that relate to the entity's financial position are change in accounting estimates. So that's it. Now question number 5. During 14-15, Chiri Limited discovered that some products that have been sold during 13-14 were incorrectly included in inventory. Oh, some products you have sold, but still it is shown as inventory. Chiri Limited's accounting records of 14-15 show sales of 1,04,000, cost of goods sold 86,500, including 6,500 for the error in the opening inventory. Oh, because closing inventory you have 6,500, so current year opening inventory 6,500. It is included, and income taxes of 5,250. Okay, so sales 13-14, 73,500, cost of goods sold 53,500, profit 20,000, income tax 6,000, profit 14,000, and basic and diluted EPS 2.8. So here there is an error. So 73,500 was sales, but some goods which you sold costing 6,500 is not shown in cost of goods sold. So actually 6,500 cost of goods sold should be more by 6,500, and as a result your corrected profits should be 13,500. Okay, and the tax should be 13,500 at 30 percentage. 6,000 out of 20,000 percentage is 30, income tax rate is 30 percentage, so it is 4,050. So the corrected profit should be 9,450. Okay. In 13-14, opening retained earnings was 20,000 and closing retained earnings is 34,000. Yeah, 20 plus current year 14. Chiri Limited's income tax rate is 30%. It had no other income. Chiri Limited had 50,000 equity shares. Okay. Show how this will be treated or accounted in Chiri Limited statement of P&L, statement of change in equity, and notes. I think this is very simple. This is very easy. So we'll correct it. So current year sales and cost of goods sold is also given. 13-14, as I said, sales 73,500. Cost you increase by 6,500. So the same thing we have calculated. 9,450 by 5,000, it is 1.89. Current year is this 1,04,000 given, 1,04,000 given. Cost of goods sold 86,500. Eliminate that 6,500. So 80,000. So income tax is 24,000 into 30 percentage. Profit EPS. Now statement of change in equity. Uh, So do I need to prepare the opening balance sheet? Actually, it is not required to prepare opening balance sheet because the error was in the previous year. When the error is before the previous year, then opening balance sheet would have been a discussion. Error is in the previous year. So thus correct previous year and current year. If error was 3 years back, then you do retrospectively and make the adjustment in opening balance sheet. But here the error is in previous year, just previous year and current year. So previous year 20,000, share capital 50,000, last year 9,000. So opening 20,000, previous year 9,450, then current year 16,800. Share capital no change. Extracts will show the impact. In 13-14, that is previous year, increase in cost of goods sold. So as an increase in cost of goods sold means decrease in profits. Decrease in profits means decrease in income tax. So overall net effect in profits. Okay. So effect in basic and diluted EPS. So previously it was EPS was shown as 2.8 and now it is 1.89. So 2.8 minus 1.89, it is 0.91. Inventory reduced, income tax payable, decrease in equity, same thing. So this is just a repeat. This is in P&L impact, this is balance sheet impact. Okay, I'll read this question number 6. In its financial statements for the year ended 31st March 2012, Y Limited reported 73,500 revenue, 53,500 cost of sales, 6,000 income tax expense, 20,000 retained earnings, and 34,000 retained earnings, 24,000 retained earnings at 1st April 11 and 34,000 retained earnings at 31st March 2012. Okay. In 2012-13, after 2001-2, the financial statements were in 12-13. After that 11-12 financial statements were approved for issue, Y Limited discovered that some products sold in 11-12 were incorrectly included in inventories at 31st March 12 at their cost of 6,500. The same error which we have seen before. Okay, we know the correction, that is current year is 31st March 13 or current year is 2012-13. So there is a correction in 2011-12. Nothing to be done on 1st April 2011. So here we will do the corrections in 11-12 and accordingly 12-13 will be corrected. Okay, that we have already seen. Fine. In 12-13, Y Limited changed its accounting policy for measurement of investment in associates after initial recognition from cost model to fair value model as per Ind AS 109. Okay. Okay. So there is from cost model to fair value model as per Ind AS 109. See, this is with regard to Ind AS 27. Separate financial statements. If you have an associate, you should prepare consolidated financial statements as per Ind AS 28. Now, when you prepare separate financial statements, that investments can be recorded either at cost model or as per 109, that is fair value FVT P&L or FVT OCI. Now, the company was following cost model and now it is changing to fair value model, which is change in accounting policy. Correct. It acquired its only investment in associate for 3,000 many years ago. The associate's equity is not traded on securities exchange, that is published price quotation is not available. So cost model, the price was 3,000. The fair value of investment was determined reliably using appropriate equity valuation model on 31st March 13 at 25,000. Previous year it is 20,000 and 10-11 it is 18,000. So there is change in accounting policy. So current year is 2012-13. Current year actually from cost model you are changing to fair value model. But if it is change in accounting policy, I need to do the correction retrospectively. Yes or no? We need to do the correction retrospectively. So previous year 11, 12, it was 20,000 fair value. Then beginning of previous year, 1st April 2011, it is 18,000. So 12, 13 is the year in which we are doing the correction, but we need to do it retrospectively. So for beginning of the previous year, 3,000 has become 18,000. There is a gain of 15,000, which is the one I should report first. Then there is an increase of 2,000 to be reported in P&L. Then there is an increase of 5,000 to be reported in P&L, and always check the tax impact. If there is a gain, there will be income tax expense also. Gain reported means there will be income tax expense. If tax rate is given, tax rate 30%. Net impact is, gain means tax payments. So tax liability, so here it will be 10,500. Here 30% means 1,400. Minus 30% gain coming, you have corresponding tax impact. So 3,500 will be the net income to be increased, and corresponding effect will be in investments and then P&L, retained earnings. So investment will increase, correspondingly gain in retained earnings. So after giving effect to the tax impact. Are you clear? Okay. In 2012-13, as a result of usage of improved lubricants, Y Limited reassessed the useful life of machine from 4 years to 7 years. Okay, the machine is depreciated on straight line method to a nil residual value. It was acquired for 6,000 on 1st April 2010. 6,000 on 1st April 2010 means 1011, 1 year depreciated. 6,000 divided by 4 years originally. So 6,000 divided by 4, depreciation was 1,500. Year 1 depreciated, 1011, 1112 depreciated, so 3,000 already depreciated. Now there is a change in useful life from 4 to 7. 4 years to 7 years, which means what is the remaining useful life? Remaining life is 5 years. Remaining life was only 2, but revised to 5. Remaining useful life is 5 years. So there is change. The change in useful life is an example of change in accounting estimate. It's an example of change in accounting estimate. So revised depreciation becomes 3,000 divided by 5 years, that is 600. Depreciation decreased as a result of change in estimate. So prospective accounting, 900 is the profits that will increase. So give the tax impact also and find out how much is the profit after tax that will increase out of change in accounting estimate. Y Limited's accounting records for the year ended 31st March 13, that is current year, before accounting for changes in accounting policy and accounting estimate. Okay, 1,04,000 was the revenue, 86,500 cost of sales, including 6,500. There is an error correction to be done. So 1,500 depreciation. So 1,04,000 minus 86,500. 17,500 is the profits. So tax expense is 5,250. So into 30%. Yeah, 5,250. Then there is depreciation to be corrected. Okay. Y Limited presents financial statements with 1 year of comparative information. For simplicity, the tax effects of all items, income and expense should be assumed. You consider tax effect on all income and expense at 30%. Draft an extract showing how the correction of prior period errors, change in accounting policy and change in accounting estimate could be presented in statement of P&L and effect in corresponding retained earnings. Disclose it in notes. Okay, a big question. I don't know whether it will be asked for exam, but just feel quickly. So let's go through. Very simple actually. So 2011-12 for previous year. 73,500. If you are with me, they have already given in the question that 73,500 was the profits, 53,500 cost of sales. But this 53,500 cost of sales includes 6,500 closing stock, which is not there in closing stock anymore. So closing stock is to be reduced. So which means my cost of sales will increase. Yes or no? 53,500 plus 6,500. So closing stock reduced, profits reduced, cost increased. Okay. Then what is this 2,000? I didn't understand. 11, 12. There is another income they have added, other income. Yeah, that is 18,000 investment value has become 20,000 FVTPL unless otherwise specified 2,000 gain. 15,500 income tax expense. So there is an error correction. There is a change in accounting policy, that restatement. Then change in accounting estimate is only in the current year. So no impact. So I have given two adjustments. One is cost of sales. The other one is other income. Profits increased. Okay. Now current year 1,04,000 revenue. Now cost of sales. Cost of sales, what are the adjustments of cost of sales? Cost of sales, how much is the cost of sales given? 86,500 cost of sales including 6,500. So now 6,500 is included as opening stock. Opening stock is to be eliminated. So 6,500 I reduce, so 80,000. Now 80,000, is there any other adjustment? Depreciation. Depreciation has reduced by 900. Depreciation reduced by 900. So that is why 86,500 minus 6,500 minus 900. So this expense reduced because opening stock is erroneously recorded by a 6,500 increase that we have eliminated, and 900 also we have eliminated because expense reduced. Now other income, there is 5,000. Okay, this 5,000 is 20,000 has become 25,000. 20,000 has become 25,000. Okay. So these are the corrected profits. So is there a difficulty? Error rectified by eliminating opening stock. So 6,500, my opening stock was more, that I eliminated, point number 1. Then depreciation, already 1,500 is charged, but now depreciation is only 600. So 900 depreciation expense has reduced. So that is to be reduced. Then change in accounting policy effect. Okay. What about retained earnings? Retained earnings. Now what is the impact of this retained earnings? Retained earnings, opening retained earnings was 20,000 given. But opening retained earnings should increase by that 15,000. How 15,000? 15,000 is 3,000 was my original cost of investment, which I increased to 18,000. So there is a profit of 15. After tax impact 10,500. So my opening retained earnings corrected. 2011-12 profits 10,850 added, 41,350. Then 41,350 plus 29,30. 62,280. So now disclosures. Now what are the disclosures? There is change in accounting estimate. Here there is change in accounting estimate. Whatever information is given, I'll write. Due to usage of improved lubricants, useful life has been changed from 4 years to 7 years. As a result, depreciation has changed from 1,500 to 600. Profit increased. So after tax effect of profit is 900 minus tax, 630 is the after tax effect of profits. Okay. Now correction of prior period errors. So that 6,500 has been sold but wrongly or erroneously included in the closing stock. So last year closing stock was more by 6,500. So we reduced, as a result that profits has been decreased. So profits 6,500 decreased means after tax effect. 6,500 minus 30%. 4550. Now change in accounting policy. We changed from cost model to fair value model. Some information is given, that is current year 31st March 13, 31st March 12, 1st April 11, profits increased 15,000, and as a result there is a tax impact, and after taxes 10,500. That is what they have written, 10,500 increase. Second year increase of investment value is 2,000, tax impact after tax profits is 1,400. So that is what total increases 11,900. Current year it has increased by 5,000. After tax impact is 3,000. The 30% deduction, 3,500. If there is a change in accounting estimate policy, we'll write the fact, what is the reason for change, and what is the financial effect. Preferably after tax effect will be disclosed. Are you clear? Now what I want to do is, now I'll quickly read the practice questions, but of that 4, 5, 6, 7, 7 is the one which we did just now, are all questions we have done. Just I'll quickly go through that 1, 2 and 3 and close the session. So please listen. While preparing the annual financial statements for the year ended 31st March 13, an entity discovers that a provision for constructive obligation for payment of bonus to selected employees in corporate office, material in amount, which was required to be recognized in the annual financial statements for the year ended 31st March, was not recognized due to oversight of facts. Oh, so here there was a constructive obligation to recognize bonus, to create provision for bonus, but it is not done. A provision was required to be created on 31st March 2011. 11, 12, 13. So there is a misstatement. There is an error. There is an error. The bonus was paid during financial year ended 31st March 12 and was recognized as expense in the annual financial statements for the said year. Would this situation require retrospective restatement of comparatives considering that the amount was material? Of course. That is, while preparing the financial statements for the year ended 31st March 13, an entity discovers that a provision for constructive obligation, that is obligation which you constructed or created out of past practices, for payment of bonus to selected employees in corporate office, which is material in amount, was required to be recognized in the annual financial statements for the year ended 31st March 11. So you are in 2013 now, 31st March 13, last year 31st March 12, again 31st March 11, you are required to recognize the provision which you have not recognized. Bonus was paid during the financial year ended 31st March 12 and was recognized as expense in annual financial statements of the said year. Now we realized previous year it is paid as expense, previous year it is paid and recognized as expense. Would this situation require retrospective restatement of comparatives considering that the amount was material? Yes. So whether correction is required? Yes, correction is required. So what correction is to be done? 31st March 2011, you have not recognized bonus liability. So 31st March 2011, your liability is less. The journal entry should have been bonus to bonus payable. So expense and liability is understated on 31st March 11. On the other hand, 31st March 2012, your expense is overstated. So expense should have been recognized in 10-11 and not 11-12. So you need to prepare the opening balance sheet and you need to show the correction. Okay, let's see the answer. What is given? Question number 1. As per Ind AS 8 errors, first they have given a paragraph on errors which you read. Third balance sheet is required. Okay. See, listen. What is the answer? Read all of you. In the given case, expense for the year ended 31st March 11 and liabilities as at 31st March 11 were understated because of non-recognition of bonus expense and related provision. And expense for 31st March 12 on the other hand were overstated. Okay. To correct it, restate the comparative amounts, present third balance sheet at the beginning of the preceding period where it should recognize provision for bonus, and you should recognize the liability corresponding effect to retained earnings. Okay, error should be corrected. Now, question number 2. While preparing interim financial statements for the half year ended 30th September, an entity notes that there has been an under accrual of certain expenses in the interim financial statements for the first quarter ended 30th June. The amount of under accrual is assessed to be material in the context of IFR. However, it is expected that the amount would be immaterial in the context of AFS. Management is of the view that there is no need to correct the error in the IFR or interim financial statements, considering the amount is expected to be immaterial from the point of view of annual financial statements, whether management's view is acceptable. What is given in the standard? Errors can be material errors or immaterial errors. The financial statements cannot be considered as in compliance with Ind AS if there is material errors or immaterial errors intentionally committed. If there is an immaterial error also, the financial statements will be considered as not in compliance with Ind AS. So you need to make the correction. So the management's view is not acceptable. Question number 2, as per para 41, you need not write as per Ind AS 8. Financial statements do not comply with Ind AS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position or performance or cash flows. So please go through the answer, which is very easy, and finally management is required to correct the error. Now the third one also we'll quickly read. ABC Limited has an investment property with an original cost of 1 lakh, which it inadvertently omitted to depreciate in previous financial statements. Error. The property was acquired on 1st April 11. The property has a useful life of 10 years and depreciated using straight line method. Residual value is nil. How should the error be corrected? For simplicity, ignore tax effects. So you need to start correcting from, so current year is 31st March 14. So 13/14, 12/13, 1st April 2012. You need to make the correction retrospectively. So the effect should be given in the opening balance sheet, that is beginning of the previous year. You need to make the correction, that is the asset should be recorded at, if 1 lakh is the cost, useful life 10 years. So 10/11 it should have been depreciated by 10,000. So 1st April 2012 the asset should be reported at 90,000. 10,000 loss in retained earnings. Second year 80,000. Then now 70,000. The effect should be current year and previous year effect is in P&L, and opening will give the effect to retained earnings. Okay, the error shall be corrected by retrospectively restating the figures for financial year 12-13 and also presenting the third balance sheet, which is the beginning of earliest period presented in the financial statement. Okay, 4, 5, 6, 7 is very easy. We have already done. So that's it, guys. With this, we are wrapping up Ind AS 8. Focus on that lengthy questions which we have done. Meet in the next video. Thank you for watching.